$12 trillion. That's how much private equity is projected to manage by 2029. It's a staggering number, but the real story is what's behind it. Firms expanding into infrastructure, secondaries, private credit, and redefining how they build teams, structure the deals, and create value. If you work in or around private equity, this is a moment to pay attention. Explore our private equity content hub for insights, research, and tools to keep you sharp. Visit cfainstitute.org/PE to browse the collection.
Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today, we're fortunate to have with us Sal Galatioto. Sal is one of the most respected voices in the sports business. He was previously named the King of Sports M&A by Bloomberg Businessweek, and he's also the founder and president of Galatioto Sports Partners, which has been engaged on over 130 transactions globally over the past 20 years. Prior to forming his own firm, Sal was head of both S.G. Cowan's and Lehman Brothers sports advisory and finance groups. Sal, welcome to the podcast. It's a pleasure to have you.
My pleasure.
Sal, before we discuss the sports industry in greater detail, can you share with us, how your career evolved into sports finance and some of the drivers of your success?
Well, first of all, I got into the business completely by accident. I worked at a French bank called Société Générale, and I took over the East Coast region, which was our largest banking business outside of metropolitan France. We had $6 billion in assets and, 11 billion in commitments. But if you look at return on equity and return on assets, it was tiny. And why? Well, who were our customers? Our customers were PepsiCo, United Technologies, Coca-Cola. You're not going to get a spread on those things. Everybody knows there's a risk-return equation, right? And when you're dealing with companies like that, the risk-return equation is not going to give you very much a return. So I looked at a dozen different businesses which I could move into as a side business. And every business I looked at had a dominant player. Mining and minerals, oil and gas, technology. There was some immovable bank that was running it. Okay. But I looked at sports. I put together a research paper. Took me 3 months, sent it to Paris, took the French at least 3 months to say, okay, you can do this, but do it in a very small way. And when I started the business, my first client was the San Antonio Spurs. You could have purchased the Spurs for $80 million. They played in a football stadium which is called the Alamo Dome, that had a big curtain that went across the middle of it. And they put a basketball court in half the building. They didn't even have audited financial statements. We're talking about a candy store. That's the way these things were run. And so I figured out, I forced them to get audited financials. I figured out a way to lend them some money, built the business out. And then in 1999, a man named Dan Snyder, who couldn't get anybody to represent him, came to me. And at that point, I was kind of a one-man band. This was a side thing I was doing while I was running the East Coast region. Asked me to represent him in the purchase of the Redskins, then Washington Redskins, now Commanders. What we did was, at that time, there was the NFL bylaw said you could only put $100 million of debt against an NFL team secured by the team. I kind of looked at that. I figured out that there was a loophole. I formed a structure that formed a holding company. I never took the team as collateral. I took the dividends and distributions coming out of the team as collateral. I took that structure to Moody's and Standard & Poor's. It was the first sports loan ever rated. It got a BBB plus rating by both. I was able to raise $700 million. I only needed 350. So I could put more leverage on my bid, on Dan's bid, than anybody else. And we wound up buying the team, the building, and 120 acres of real estate around the building for $800 million. That deal put me on the map. The business grew exponentially after that. And then I realized that you could do buy-side stuff at a small firm, but if you want to do sell-side stuff, you needed to move to a bigger firm. So I moved to Lehman Brothers. I moved my whole team over. We got there in 2001, and unfortunately, we were directly across the street from the North Tower of the World Trade Center. So when the tower collapsed, it basically destroyed our building. We had to move to a hotel in Midtown Manhattan, and we worked out of that. And when we were at Lehman, we did a bunch of historic transactions. We helped finance George Steinbrenner's founding of the Yes Network. We represented Disney when they sold the Angels and the Mighty Ducks. We represented the Wilpon family when they bought the half the Mets they didn't already own. And so we grew the business pretty quickly at Lehman. And then just over 20 years ago, I decided that Lehman wasn't a great environment for me. But leaving from Lehman was a little tough, but I knew we could do it. And look, basically our business is as much a know-who business as a know-how business. Once you establish good relationships with the owners of the teams, you'll get your share of the business. And that's what we did. We kept building. And then we, as the value of the teams got bigger and bigger and bigger, you're talking about $10 billion for the Lakers and, $6 billion for the Commanders. The bigger firms on Wall Street started to look at the business seriously. And so we shifted our strategy, and now the bulk of what we do is we sell limited partnership stakes in teams. And there are a lot more LP sales than there are GP sales. So we focus on that. We're having a very strong year this year. We had a very strong year last year. And it's a great business. It's a great business. We know everybody. You build a reputation. You're good at what you do. It's just different. It's very different. I'm sure your audience is much more focused on the numbers and how you value things on a numerical basis. It's not that way in sports. It's very different. It's the only business I can think of that sells on a revenue multiple basis and not an EBITDA basis, because many of these teams don't have EBITDA. Actually, some of the biggest names in sports lose money.
But you touched on what really grabs a lot of headlines: rising valuations. They continue to be in the news. Sort of at a high level, what inning do you think we're in for valuations as a whole? And within that, are there particular sports teams or leagues that you think are sort of early in their valuation expansion?
I think valuations are going to continue to go up for a number of reasons. First, the scarcity value. They're not making any more of these. So it's basically a fixed number. Yeah, once every 20, 25 years you have expansion, but they'll add one or two teams, okay? So scarcity value, media content value. There is no other media content like this, okay? As technology continues to improve and people are able to record their favorite shows and edit out the commercials, and the value to the advertisers of most content goes down. Except here, 99.5% of people that watch sports watch it live. There's no other content like it. And so the value to advertisers continues to grow. As AI and a lot of other things develop, people are going to have more leisure time. And in that leisure time, they're going to consume more sports content. So you can see gaming growing, and you can see shoulder programming for sports growing, and there's a continuous growth in that. Now, will these valuations go up as fast as they are now forever? No, trees don't grow to the sky, and they'll start to slow down at some point, but I don't see that right now. The valuations are really, really strong. NFL valuations are incredible. And I think they will continue to be, because given the collective bargaining agreement, given a salary cap and a salary floor, the short careers of the players, so there are very few guaranteed contracts, and the way the collective bargaining agreement splits up the revenues, I mean, everybody gets the same share of the national media contract. There are no local media contracts except for radio. So it doesn't matter whether you're in Buffalo or New York. The only difference between what you receive in terms of revenues and what your competitors in a giant market receive are venue revenues. That's it. And since there are so few games, the venue revenues aren't as important as they are in other sports. And a visiting team gets a share of the revenues they get when they go visit Dallas or New York. So it is the only place in the world, and I'm a student of history, where socialism actually works. It's socialism for billionaires. Okay. Then you have the other sports where getting people in the seats is much more important. Baseball has many more games. There are local media contracts and there's a national media contract in baseball. And so if you're in a big market like New York or Los Angeles or Chicago, you're going to get a pretty big local media contract. And you won't in markets like Kansas City and Tampa, for instance. Okay, but there's also extensive revenue sharing in baseball. About 48% of all local revenues go into a pool, and then they're redistributed. So if you're the Yankees and your local revenues, I'm making this up, are $100, and you're the Kansas City Royals, whose local revenues are $20, 48% of that goes into a pool and then redistributed evenly. So the difference between baseball and football is, besides the fact that getting people in the seats is much more important for baseball, is there's no salary cap. So if Steve Cohen wants to spend, I don't know what the reported number is, $340 million in payroll on the Mets, and you're a small market team and you spend $60 million in payroll, you can do it. There's no floor, there's no cap. And so you determine whether or not you make money. If you spend too much, you're going to lose money. If you're thrifty and run your team very well, one of the best run teams in all of sports is the Milwaukee Brewers. They have a very low payroll, yet they compete consistently year in, year out, and they're able to do it. They realize they're in a small market and they're constrained on the amount of revenues they can generate, and yet they have a tremendous front office which punches way above its weight. And the other sports are kind of in between. The National Hockey League has a cap and a floor, and so you're really restricted in how much money you can spend. The NBA has a soft cap, so you can exceed it significantly and pay luxury tax. And again, you determine whether or not you're going to make money. So the single largest expense is payroll. That's it. The other thing about this business that people love is the product life cycle is very long. Very long. You don't have technology risk. Yeah, as technology continues to improve, product life cycles of business is shrinking, right?
Another aspect, Sal, is in the sports enterprise valuation, real estate, arenas, stadiums. How important is that to own and just for overall transaction value?
It doesn't matter whether you own the building or not. If you have a really good lease and you get all the revenues from the building, it may be actually more advantageous from a tax point of view not to own the building. But the building's only worth the amount of revenues it generates, right? It's a single-use building. If your baseball team stinks, it's like, okay, you pay $2 billion for a new building. People will go to see the new building maybe once, but if the product isn't good, they're not going to come back. The key here is to have a really good product. People overlook anything if the product is good. You want more luxury suites, you want better amenities, you want to generate more revenues per seat. And that's what owners have realized. What they've realized is it's not the number of seats you have in the building, it's the amount of revenue you generate per seat. I teach at the Business School of Columbia. I've been doing it since 2003. One of the things I try to point out to the students is that when you look at attendance, for instance, in baseball, it's a fool's errand. You look at total attendance and you say, well, fewer people are going to baseball games. Well, that's because today stadiums are smaller than they were 30 years ago. Take Yankee Stadium, for instance. The original Yankee Stadium was 73,000 seats. Then they modified it and rebuilt it, and it was 58,000 seats. Now, new Yankee Stadium is 49,000 seats. But it's not the number of people you get in the building. The other thing is, it's much more expensive to build a giant building than it is a smaller building. It's what I refer to as a law of triangles. The bottom triangle, the seats closest to the field, is where you generate the vast majority of your income. Then the middle level, you generate less. But the upper level, which is the most expensive to build, you generate the least revenue from. So why spend all that money to put up something where you're going to generate very little, where you can make the stadium smaller? And new buildings are all in the 40,000s. I mean, that's where they wind up, not the 60 and 70,000 seat stadiums we had in the past.
And when you're working on a transaction, what besides the price agreement on that, what are some of the challenges to getting an agreement in place?
First of all, it depends on how many bidders you have, right? When you have a lot of competitive tension, you can kind of dictate the terms. When you don't, if it's a market that people don't want to be in, or a team that isn't a great brand name, then you may only have one or two bidders. You don't have a lot of leverage. And so that's what really determines what you can get. It's a very straightforward business. I mean, there are media revenues, there are local revenues generated by ticket sales, when you have concessions, signage. It's not very complicated. And the major expense by far is payroll. And the new owner is going to dictate what the payroll is. I mean, he may have some long-term contracts on the books, which sometimes causes a problem because there may be some really bad contracts and people want to push the price down because it's going to take them years to shed those contracts. But generally, it's a matter of how much competitive tension you have.
And often, in an M&A transaction, integration risk, sort of post a transaction, is something that's discussed. I'm just wondering, in transactions like these, once the deal is done, factors think going forward that an owner will face once he owns the team and has to operate it.
Well, I mean, it depends on his management philosophy. Like, what does he want? Is he buying this team because he wants to win? If he wants to win, he's going to spend more and more money on payroll. He's going to have partners, if he did bring in partners in the business, who are going to know they're going to get capital calls, right? And they're going to have to be in agreement that those capital calls are worth it. If you want to maximize your profits, then you're going to have to go out and either get a really great front office, which you can do. There are teams in small markets that punch way above their weights. They get the right people. They invest in analytics. They try to improve the building. And by doing all those things, they get more and more people into the building. Sometimes people buy these things and figure out that they're in a pretty old building in the wrong part of town or whatever, and they need to build a new building, and that's a major capital expense. You're going to have to take that into account when you buy the team, and that impacts the purchase price more than anything else.
And shifting to the markets themselves, there are some publicly traded sports entities. Sal, do you see sports franchises becoming a more mainstream allocation for institutional investors or even retail investors? Or is this really going to remain largely a private equity, corporate, and very high net worth domain?
That's a very good question. There are a very limited number of these teams that actually trade in the public markets. I think more and more funds are being created to invest in this asset class because people are taking the asset class seriously. It's no longer a vanity purchase. People see these as real businesses. I think you're going to have, everybody and his brother seems like they want to build a fund to invest in these things. Not many of them have been successful. There are a handful of funds that have been successful and moved into the space. But at least for the next decade or so, I see this continuing to be a space where high net worth individuals are going to really be the bulk of the buyers, either buying the whole team or pieces of the team. It's generally family offices and high net worth individuals that get involved.
Yeah, I think the only one area I was sort of curious about is So we talked about, you mentioned valuations, mostly revenue multiples. Is the investment return for sports franchises sort of not, it's just not part of the,
Yeah, look, you're never going to get a cash on cash return. If you want to maximize cash on cash return, go buy something else, buy treasury bills. You make your money here by buying in at a low valuation and selling, holding onto the paper for a period of time and then selling out. That's the bulk of what I do is I help people, most of the sales, some teams raise new capital for buildings and because they want to sign more players but the bulk of it is somebody bought a stake in their favorite baseball team 20 years ago and now their investment that was tiny is a 2 or 300 million dollar investment, and they want to get out because they have estate planning they're doing, or because they have 5 children, and the 5 children don't want to own a little tiny piece of a baseball team. They'd rather have cash. And so what they do is they come to me, and I go out and I find buyers to buy this stuff. The demand, I've never seen demand as strong. We've sold over $1 billion in stakes in Major League Baseball teams. I see no limit to the demand.
right. Let's move into some of the industry trends. The importance of an international expansion. The NFL has games in the UK, Ireland, Germany, NBA in Mexico and France. How do you see this trend playing out? And could there one day be more franchises abroad, or are these items really just about expanding the audience for the teams?
Boy, that's a really great question. I'm really good at predicting the past. I'm not really good at predicting the future. Logistics is the biggest problem. Look, you can get away with it in the NFL because you play so few games, and you play a game in London, and you don't play a game for another week. And to have a league that's structured so you have teams in Asia and teams in the United States and teams in Europe. I mean, look, technology changes incredibly. So if logistics changes and it doesn't take 12 hours to fly from Los Angeles to London or wherever the hell it takes, yeah, I mean, you could do it if you could speed it up. It's very difficult, though, if you're playing a lot of games, to have one integrated league in North America playing another one in Asia or in Europe. It's just difficult. Now, maybe you could set it up so you could have 3 separate leagues and then have a championship series. Yeah, maybe you could do that. I think part of the problem for sports like the NFL is they don't translate well into developing markets because the price of the equipment is huge. And when you're trying to play in countries where, the per capita income is low, that's very difficult. So you can get away with it in Europe, but can you do it in a lot of other places? Baseball has a huge following in East Asia, Japan, Korea, Taiwan, the Caribbean basin, Mexico, yes. Basketball and soccer are the only 2 global sports in my mind, and soccer is way ahead at this point. But basketball is making strides.
Tech companies, also an emerging force, Apple, Amazon. What do you expect from these types of companies going forward as far as their entry into sports?
I think the way to get into the business is to be able to distribute the content. And they invent new ways to distribute the content, which sometimes are much more efficient and sometimes reach many more people. I mean, technology is evolving so quickly, but as a distributor, they're going to be a major force, no doubt.
So early innings for those type of companies,
I
you
think
think?
so, but they're coming on pretty quickly.
You also have convergence between media and sport. ESPN announced a transaction to acquire the NFL network. The NFL received a stake in ESPN. Can you share with us, what the rationale is between these types of deals, and do you expect more of them, either domestically or internationally?
The rationale in doing something like that, I mean, I could see why the broadcasters want to be involved because this is premier content and they're worried about exactly what you said. What happens if technology companies get involved and traditional broadcasting just fades away, right? They want to kind of hedge their bets, and I can understand that. I think you're going to see more deals between the leagues and big tech companies. I think you're going to see more deals between the league and other forms of broadcasting. I think that's just going to happen.
And moving into another trend, sports betting. It's exploded in the U.S. From your perspective, how has this changed the landscape for leagues and team financially?
What it does, besides advertising revenues and stuff like that, is that people are consuming content that they wouldn't ordinarily consume. You love Celtics basketball, you watch Celtics basketball, but you don't really care if the Kansas City Royals are playing the Seattle Mariners, right? Except if you put a couple $100 down on the game. So people are starting to watch games and sports that they have no rooting interest in because they are wagering on them. And as long as they're watching them, that is value to advertisers. And so what happens is sports ratings go up. When gambling was allowed in the United Kingdom in the EPL, the ratings for EPL games went up and up and up. Well, why? Well, because people weren't just watching their favorite team, they were watching every team they put money on. And some gamblers gamble on numerous sporting events every week, and they're going to consume that content. So that's a real positive for the sports leagues.
And you touched on a lot, Sal, the sort of the big four leagues and now sports betting. But going forward, beyond those, are there other areas that you find introspective that haven't fully been realized in this industry?
I have focused on the four big leagues in North America. I do some European soccer, but only because some of my existing clients in North America that already own teams decide to invest in Europe. We're a 9-person firm. We're tiny. Now, we punch way above our weight and we compete with the JP Morgans and the Goldman Sachs of the world. But they have global networks where they can get involved in other sports outside the US. In terms of developing sports, because we are small, we focus it, and because our business is good, I'm not going to move away from what I know best. Yes, there are a lot of emerging sports, but again, we go back to the risk return equation. You're going to get a higher return, maybe, but you're taking a lot more risk. And I don't know if those sports are going to ever develop. They may. I mean, I've been wrong before.
You've touched on rising valuations, and you work with private equity, tech companies, media players. Despite the high level of due diligence they may conduct, are you surprised sometimes, or are there areas that you think these investors still underestimate once they own a team? You touched on payroll and things like that.
Yeah, because it's a business that has a lot of emotion attached to it, right? It's not like you're buying a widget factory and you decide, I'm going to go to robotics to cut my employee costs. This is a business that once you get involved, you don't think you're going to be rooting for your team. You don't think you're going to be carried away, but you will. And if you think you're one player away from winning, you're going to spend money on that one player. That just starts to happen. Now, some people are more disciplined than others, which is great. But remember, you don't become a billionaire by buying one of these teams. You're a billionaire and then you buy one of these teams. So most of the owners, not all, but most, this is an ancillary business. This isn't their main business. I can tell you that I've had owners over the years who are worth $30 billion, and their sports team represents 3% of their net worth. And they would talk about their sports team all day long and talk about their other businesses for 5 minutes. It's different. It's special. It's high profile. That's the other thing, right? You're a person that's $10 billion. Nobody knows who you are. You buy a professional sports team, everybody knows who you are. As I used to say when newspapers actually were read by people, it's the only business that has its own section in the newspaper every day. The amount of visibility you get is way out of proportion to the actual value of the team.
And a somewhat ubiquitous topic, particularly this year, AI. How important do you think that is for the business side of sports, from say pricing to fan engagement to operations? Is that something that has the potential to really transform this business at all?
I think it will transform the business. It'll transform every business. But I think what AI is going to do before it wipes us all out is give us a whole bunch of leisure time. You're going to have a lot of people who unfortunately aren't going to be employed full time. And those people need something to do. And I think sports content is something that they will consume more and more of. So it's a huge tailwind for sports.
Sal, you've offered great insight into the business of sports. In your view, what will the advisory as well as sports business look like 5 to 10 years from now, you think?
I think it's going to evolve. I think you're going to see more and more large firms get into the business because these deals are big enough to get their attention now. They weren't. I mean, 15 years ago, you were talking about a $400 million deal to buy an NBA team. Now you're talking about 10 billion, 12 billion, who knows? So you're going to get more financial institutions are going to come in. I think you're going to find that as sports starts to globalize, you're going to start to see more foreign financial institutions get involved. They're not really involved yet.
Sal, thank you for joining us today and sharing your unique and highly valued perspective. And to our listeners, thank you for tuning in to Compound Insights from New York. I'm Gary Farber, and we look forward to bringing you more conversations with leading voices in finance, and we'll see you again soon.